Now, the listed property sector has continued to deliver outstanding returns over the last year, with some property funds seeing total returns, which include dividends and capital gains, north of 40%. But how long can the party continue, and has the market run ahead of fundamentals? Evan Jankelowitz from Sesfikile Capital joins us in studio to share his views. So, is the party nearly over by any means?
I'm not too sure that's right, because at the moment we're still trading at a forward yield of 6.5%. Growth still quite strong at 7.5%. Fundamentals aren't great, but they aren't terrible either. So that growth is pretty much in the bag in the next 12 months. And if you look at global bonds in the region of 2.5%, there's still a need for yield globally. And if the foreigners keep on buying our bond markets, and even if the locals still have an appetite for our the bond space and that yield, that'll push yields down, and in turn that'll push property prices up.
Evan, just to explain that a little bit for our audience, is that obviously the way I understand it, global investors look at property yields and bond yields through the same lens. So if bond yields go down, the yields in listed property go down as well. Is it an accurate way of describing it?
It's not completely linked. It's really an opportunity cost. Property, by definition, have to pay out all of their earnings as a distribution. So because of that annuity-based return that they give, they compared a lot to those fixed income instruments. So but in turn, if the bond yields compress, property yields should also compress, and that increases the prices.
Let's talk about some specific industry issues that are happening right now. Growthpoint's capital raising being hot on the agenda. Where do we stand on that one?
There's a lot of capital raising. Growthpoint was one of the biggest in history, really, in the local property space. 2.5 billion rand, and it was taken in a day. It was an accelerated book build. You didn't have to line the guys up for weeks on end. They came out in the morning and they really sold out 2.5 billion rands worth of assets. With that said, they're not the only ones that have come to market, and they're definitely not the last ones that are going to come knocking on the door. There's a range of new listings, and in our view, in the region of around about 8 billion rands of new stock potentially coming to the market, and existing companies also need to come back.
So who's picking it up? Who's most excited about the property story?
That's a very interesting fact there, is that if you look at the seasoned property veterans in the markets, they're a little bit hesitant at current prices. They haven't seen yields this low for quite some time, but you're starting to see the generalists come in. So, and again, we spoke earlier about the foreigners. Let's put the foreigners aside. Yes, they are picking up a little bit, especially with the introduction of the REIT regime in South Africa.
Right.
So it's a lot more vanilla for them now. But it's the generalists that are coming to buy property. They missed the bandwagon. Well, they weren't on the bandwagon for the last, call it 8 years. And they're starting to see there's liquidity in the sector. They're still getting a little bit of a carry on the yield, and the guys are buying. I've seen certain names on the register that I've never seen there before.
Evan, what are Growthpoint going to do with 2.5 billion rand?
There's some speculation. We keep our ear to the ground. I'd rather not say, because I spoke to management and they were very mum on it. So I don't think they want the market to know, but I think they have a lot up their sleeve. They can spend it locally, and they can spend it in Australia. My view is they will spend it locally, and there are 1 or 2 big portfolios that would be accretive to their asset value, as well as it gives them let's call it, something to work with. They're great managers, and if you give them a new set of assets, it gives them the ability to churn out value from those assets.
Well, while we're talking about Fountainhead, let's enter Redefine into the story and the punch-up, so to speak, around the Fountainhead assets.
I think they rang the bell on that, and the round's over. Well, for the time being, Growthpoint haven't withdrawn their cautionary, but at the moment it looks like Redefine have got away with most of what they wanted. They didn't come up with first prize because they wanted to take out the whole company. Because of the tussle between themselves and Growthpoint, they weren't able to take their whole company out, so they left with just over, call it a 45-46% stake in Fountainhead. They control the Manco, and in time they will take out the rest of the company. But at the moment, they're already stuck in that position.
Is this how you thought that it would end, for
This
want
is
of a
really
better way to put it?
how we hoped it would end. And I think it's a good thing. Why? Is because if Growthpoint got it, Redefine would have lost a very material asset which they just bought from Standard Bank and Liberty, and they really would have had to write off around about a 700 million rand asset, and that would have been our shareholders' money. So that would have been written off as nothing, and it gives the likes of a Redefine a little bit more liquidity. It's not just Growthpoint and the rest. Redefine is a significant player there as well. So you've got two big guys in this sector.
Not bad for the industry.
Not bad for the industry. No, it really would have been good to see what Growthpoint could have done with those assets. As I said, they are really good operators, but I think it's worked out fine for everyone at the moment.
Evan, we've got all this capital raising. It's been a great market for property companies to come and raise equity. Tell us what's happening on the debt side, and perhaps just tell us, when you're talking about that, how this REIT structure affects things, because this is a new idea for South African investors, but one structure that's been used around the world.
Okay, so let's start with the first question. As we said, guys are coming in with huge demand for equity. So they come in, they want to raise capital in the equity markets, but they're also raising in the debt markets. And a lot of the new debt that's coming through is commercial paper. They're getting better rates than if they went directly to the banks. And so there's a lot of innovation coming through. And again, back to Growthpoint, they were one of the initiators of this. So you're seeing guys squeeze margins more and more on the debt side. Equity, they're getting at good price as well. So they're able to pick up a lot of prime assets in the market. Speaking on the flip side to the REIT structure, really, I think it's just kind of a rubber stamper on some sanity for everyone, locals and the foreigners, to get a stock standard product. To be very honest, a property loan stock and a property unit trust, the existing regime was pretty much a REIT. If anything, just by name, it was a little bit different. But this gives the foreigners a little bit more comfort, and also it appeases the likes of SARS. And there were one or two issues that they had to get around. Let's call it the same products, but it's just a little bit more vanilla as the structure for investors to look at.
Are there any opportunities out there that you've been picking up that you can throw forward to on the show?
Yeah, well, there's definitely opportunities. Our biggest overweight, and it doesn't look like a dripping rose with regards to pricing, but we like it very much, is Hyprop. They haven't done as much as some of the peers, and with it's funny, with Redefine selling out of their Hyprop to buy Fountainhead, there's a little bit more liquidity, a little bit more free float, and with the adjustments of the property index, you'll see that Hyprop increases in its free float weighting. So I think there'll be a little bit of a marginal demand for it, and they are great assets. You're buying top